Hello everyone, you're very welcome back to the channel. Today we're looking at the commonly asked question, why are mortgage rates so high in Ireland? The reason why I say we're looking at the question as opposed to answering it is because as of March 2023, mortgage rates in Ireland actually aren't that high. Yes, Irish mortgage rates are at their highest level since 2017. However, when looking at this question, it's not necessarily the rates themselves which matter. It's how Irish rates are stacking up against rates charged in other Euro area countries. As you'll see later in the video, the most recent data from the Central Bank of Ireland contests the widely accepted notion that mortgage rates in Ireland are, comparatively speaking, high. However, it's not like there was never any merit to this argument. For example, back in October 2019, the weighted average interest rate on all new mortgages agreed in Ireland was 2.93%. This was the second highest rate in the Euro area, just behind Greece. At that time, the average mortgage rate for the Euro area was 1.37%. Therefore, Ireland's rate was 1.56 percentage points higher than the Euro area average. That's a very significant difference. When applied to a €300,000 30-year mortgage, the difference in cost between the two rates is €83,436.54, or a percentage difference of 22.82%. On paper, this made housing affordability in Ireland more challenging than in many Euro area countries. That begs the question, why were mortgage rates in Ireland so high in the past as compared to the Euro area average? Well, the first point to note is that since 2015, there has been a major change in the profile of Irish mortgages. Just before 2015, around 10% of new mortgage agreements in Ireland were fixed rate mortgages, as compared to the Euro area average of 70%. In other words, Ireland's mortgage market up until 2015 was dominated by variable and tracker rate mortgages. Fast forward to 2019, where 75% of new mortgage agreements in Ireland were fixed rate mortgages, much closer to the Euro area average of over 80%. In 2022, the Central Bank of Ireland released a paper entitled Rising Interest Rates and Higher Inflation: Implications for the Banking Sector. This paper clearly illustrates the shift in the type of interest rates that are outstanding on Irish mortgage loans. At present, the majority of mortgages in Ireland are 1 to 2 year and 3 to 5 year fixed rate mortgages. Why does this matter? Well, during the period between 2011 and 2019, the average interest rate on new fixed rate mortgage agreements in Ireland was consistently higher than the Euro area average. In 2019, the average Irish rate was 2.83% as compared to the average Euro area rate, which was in the region of 1.6%. This partly explains why Ireland had the second highest mortgage rates in 2019. Large numbers of homeowners were opting for fixed rate mortgages at a time when Irish fixed rates were well above the Euro area average. But why were homeowners opting for fixed rate mortgages at this time? What caused this shift in the Irish mortgage market? On the 16th of March 2016, the European Central Bank reduced the main refinancing operations rate to 0%, and it stayed at 0% until the 27th of July 2022. The refi rate being at 0% is essentially as good as it gets in terms of mortgage rates. In theory, when the refi rate is at 0, coupled with negative deposit rates, a bank's cost of funding should be at its lowest, which in turn should allow the bank to offer lower mortgage rates. This is especially true for Irish banks, who at that time were also offering among the lowest of deposit interest rates in the Euro area to their customers. In fact, that largely hasn't changed despite the ECB's continuous rate hikes since July 2022. Indeed, between 2016 and 2019, the average interest rate on new fixed rate mortgage agreements in Ireland steadily declined. This was a prime opportunity for homeowners because although rates were high as compared to the Euro area average, this was likely going to be as good as it gets. But that doesn't explain why historically Irish mortgage rates have been higher than the Euro area average. Answering that question is a bit more of a challenge. According to the Banking and Payments Federation of Ireland, risk-weighted asset density on mortgage loans in Ireland is significantly higher than the average for comparable European countries. Average RWA density for mortgages in the Irish banking sector has reached 37% as compared to European averages at around 13.3% as of the end of 2019. What does that mean? To keep a long story short, the value of a bank's capital must be kept at certain minimum levels relative to the bank's risk-weighted assets, or RWAs. The higher a bank's risk-weighted assets, the more capital the bank must hold. For example, the BPFI calculated that that for every 100 billion euro worth of mortgages, Irish banks must hold 5.76 billion euro worth of capital. That is nearly 2.74 times more capital compared to the Eurozone average and 3.4 times the requirement in both Spain and France. The research from BPFI suggests that Irish banks are required to hold much more capital against their mortgage book than the rest of Europe. Capital doesn't just appear out of thin air. A bank needs to actively take steps in order to increase the value of its capital relative to risk-weighted assets where necessary. There are a number of ways that this can be done: a reduction in dividends, a widening of net interest margins through higher rates, the issuance of new equity, deleveraging, a curtailment of lending growth, and or a migration from high risk-weighted assets to low risk-weighted assets. Out of all of these options, increasing mortgage rates is the most attractive. This might explain why historically Irish mortgage rates have been higher on average. The BPFI also notes that the RWA density of Irish mortgage loans is not yet reflecting the higher quality of loans that have been made since the loan to value and loan to income limits were introduced in 2015. They note that the RWA calculation process is based on the 2007 to 2013 experience, effectively trapping capital requirement levels at crisis levels. If RWA density was to fall in the future to reflect higher quality mortgage loans, then we could see Irish mortgage rates come down. It was also noted in the BPFI paper that Ireland has one of the worst outcomes in Europe in the recovery of security for mortgages under judicial processes. In Europe, the average recovery rate at the end of enforcement through the judicial process is around 46% compared with only 11% in Ireland. In other words, it's very hard for Irish banks to reclaim a property when a mortgage holder is defaulting on his or her obligations, which in turn makes the mortgage a riskier proposition, thus leading to higher capital requirements for banks and higher mortgage rates for customers. Despite all of this, the latest data from the Central Bank of Ireland paints a different picture of Irish mortgage rates relative to our European counterparts. The weighted average interest rate on new Irish mortgage agreements at the end of March 2023 was 3.54%. Mortgage rates have increased significantly between November 2022 and March 2023, while new mortgage volume has fallen. However, Irish mortgage rates, while above the euro area average, are among the lowest in Europe. Only Spain, France, and Malta are offering lower rates. There are a couple of things to note here. Firstly, this report, which was released on the 10th of May 2023, relates to mortgage rates as at the end of March 2023. Bank of Ireland increased its fixed rates for new customers by 0.5% on the 31st of March 2023. As such, the effects of this increase won't have been accounted for in the central bank's latest report. The same goes for the EBS and Haven variable rate increases in April. This likely means that the weighted average interest rate on new Irish mortgage agreements today in May 2023 is higher than the figures from March. Secondly, the ECB raised rates by a further 0.25% this month, and they also signaled further rate increases in the future. It's likely that fixed and variable mortgage rates are set for further increases not only in Ireland but across the euro area. Tracker rates automatically increase alongside the refi rate. Therefore, average mortgage rates in the future will likely be even higher than what's presented in the central bank's report. Finally, it is important to be aware that Irish banks have been much slower to pass on higher ECB rates to their mortgage customers as compared to banks in other European countries, which is why Irish mortgage rates are among the lowest in the euro area. That is, in part, likely due to the fact that AIB, Bank of Ireland, and PTSB are flush with customer deposits, on which they're paying very little deposit interest. Because of the limited competition in the Irish banking sector, the banks exert market power over deposit rates. They don't need to offer high deposit interest rates to attract new business. This results in a low cost of funds for the banks, which in turn allows for lower mortgage rates, a luxury that many European banks don't have. This is good news for Irish mortgage holders, but bad news for Irish depositors. It's a double-edged sword, and that's not to say that Irish mortgage rates won't increase in the future. It's also worthwhile mentioning that because Irish banks have historically charged above average mortgage rates due to higher capital requirements, they have more leeway in high and rising interest rate environments. They were already at the level that other European banks needed to get to, especially those banks with a higher cost of funds. It's likely that if interest rates return to pre-pandemic levels, Ireland will once again be among the most expensive for mortgage rates in the euro area, and that's simply because the root cause of the issue, i.e. high capital requirements, won't have been solved solved. But let me know, what are your thoughts on Irish mortgage rates? Are you currently in the market for a mortgage? Do you already have a mortgage? Or are you holding off on buying for the foreseeable future? Let me know in the comments. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to show your support by leaving a like on the video, subscribing to the channel, and sharing the video with family and friends. Before you go, do check out my video analysing the Irish banking sector, which answers the question, are Irish banks safe? Thanks very much for watching, and I'll see you soon.